watching this video, there's a chance that you actually own your own company's stock, or at least have given the option to buy stock options at some point. So my question to you is, what is your strategy for the company stock? Derek Mazzarella with Gateway Financial Partners. Today, I want to talk to you about how to really handle your company stock, whether that's something you bought through stock options or whether that's something that you got through a company program like restricted stock units. So if you're lucky enough to be like Milton here and you did get some of that, and what I found is usually the higher up in the company you go, so director level or above, you're typically going to get a pretty significant chunk of your compensation is going to come in the form of company stock. And when it comes to investing overall, we really want to take a step back and talk about types of risk. And there are generically two main sources of risk when it comes to investing. The first type of risk is called systematic risk. And systematic risk looks at overall market risk. So think things like inflation, interest rate risk, political risk, foreign conflicts. Anything that really affects the overall market is considered a systematic risk. And if you're still confused, one thing to think about is like the tides. So as the tides go up, the boats go up with it. As the tides go down, the boats go down with it. Same thing happens with companies involved in systematic risk. Typically, if something affects the overall market, most, if not all companies will drop in value, or if there's, good things in the market, they may go up. So there are things that affect the market as a whole. The other type of risk is unsystematic risk. And unsystematic risk looks at individual company risk. Do they have a good board of directors? Do they have a good management team? What's their financials looking like? Are they taking on really bad debt? What's their competition look like? All of those kinds of things involve individual company risk. So one thing may affect one particular company, but won't affect the rest of the market. So why am I talking about all this? Well, when it comes to company stock, what I see most often is most people will continue to buy their stock options and accumulate stock over time, or they continue to get their restricted stock units and they accumulate company stock. So it starts out as, let's say this orange here is their company stock. It may be a small part of their individual portfolio, but as the years go by, it becomes a much bigger and much bigger portion of their overall investment portfolio. And there are definitely some risks with that because it's not like, even though there are large companies in the S&P 500, not all of them do well. Some can actually go out of business and some have. But if you look at a chart here by Morningstar, we see that looking back from 2017 to 2021, about a third of US stocks actually lost money or lost value for their investors. But we look at more diverse portfolios like US mutual funds and ETFs, only 0.1% lost money. So one of the things that we can try and do is really diversify that risk away. And that's what I'm talking about when it comes to basically, this is diversifying unsystematic risk away, because collectively they're going to say, hey, we're going to involve and invest in a large number of companies instead of just having one company that may or may not do well. So what should you do if you have company stock? First thing is decide, how much you're going to keep. That number may vary for any person, but usually what I recommend is for people to keep between 10 to 20% of their company stock and then sell the rest. The other question is, when should I do that? And the challenge that we have I have as an advisor is people tend to be really emotional when it comes to especially their own company stock. You're putting your blood, sweat, and tears into the company. So you really want it to do well and you want to be rewarded for that. You can be rewarded for that by keeping company stock. But the challenge that this has is you may hold on to that company stock even if the company is not doing well, or if there's other market factors at risk that may impact your investment. So you really want to try and remove the emotion as much as possible. And we do that by creating essentially a system to sell. And typically the best date to sell that is the vesting date. And the vesting date occurs when your company stock becomes yours. So a company may gift you company stock, but it may not actually vest or become yours until that vesting date. So by selling on the vesting date, you pay your taxes based on the vesting amount, and then you have to worry about sales or capital gains taxes or any of those other things afterwards if you sell it right at that moment. So basically, you usually would sell it on that vesting date. I've seen it be quarterly. Generally, it's semi-annually, but basically, anytime that vesting date hits, boom, we keep the stock and then we sell the rest. So if we're using this example here, let's say we get $1,000 worth of company stock. So we may keep 150 in stock, and then we sell the remaining $850 to a different position. So the third thing is, okay, well, once we sell it, now what do we do with it? Three, we really want to try and avoid keeping it in cash because we may either spend it or, quite frankly, cash doesn't earn as much as most investments do. So what we really want to do is take our company stock here, sell it, and then put it into a more diverse portfolio to help reduce that unsystematic risk, like we see in the previous slide here. Basically, we want to create an operation where we're taking money consistently from our company stock, a consistent percentage at a consistent time, because this is going to remove, hey, oh, I think the stock market's doing really well. We really need to hold on to this stock. Or, oh, I think this is going to happen with the company. We need to hold on to this. It removes a lot of the guesswork and the emotion. We create a system for removing and selling and profiting off our company stock, whether that's compensation that you get or whether that's stock options that you're consistently buying. Derek Mazzarella with Gateway Financial Partners. If you liked the video, please like and subscribe. And if you have any questions, please feel free to reach out.